The financial mistake that costs you $100,000 over time is something we've all made at some point in our lives. But what if I told you that it's not just a small oversight, but a habit that can lead to a staggering loss of over 6 figures by the time you reach retirement age? According to a study published in 2020 by Fidelity Investments, investors who have consistently underperformed the market by as little as 1 percentage point per year are likely to end up with over $100,000 less in their savings by the time they retire. This may not seem like a significant difference at first glance, but let's break it down. In 2020, the average 401k plan participant contributed around 6% of their income towards retirement savings. Assuming an 8% annual return on investment, which is a relatively modest expectation given historical market performance, and averaging in contributions over a period of 25 years, that initial $50,000 investment would grow to approximately $430,000 by the time you reach age 65. However, if you consistently underperform the market by just 1 percentage point per year, your savings would only reach around $330,000 at retirement. Now, this might not seem like a huge difference at first glance, but consider the impact over the long term. 1% may not seem like much now, but it compounds significantly over time. In fact, by age 65, that 1 percentage point underperformance would have shaved off nearly $100,000 from your savings. But how does this happen? What financial mistake are we making that leads to such a significant loss in the long run? The answer lies in our inability to adapt and change with market conditions. Many investors get stuck in their ways, sticking to the same old investment strategy even when it no longer serves them well. They fail to rebalance their portfolios as needed, neglecting to sell underperforming assets or invest in emerging trends. Section 1: The Power of Dollar-Cost Averaging. Dollar-cost averaging is a simple yet effective strategy that can help you avoid this pitfall. By investing a fixed amount of money at regular intervals, regardless of the market's performance, you're essentially buying more shares when prices are low and fewer shares when prices are high. This helps to smooth out market fluctuations and reduces the impact of timing risks. For instance, consider John, who invests $500 every month in his 401k plan for a period of 10 years. If he starts investing during a bear market, he'll be buying more shares at lower prices than if he started investing during a bull market. Over time, these regular investments will help to average out the volatility and increase the potential for long-term growth. The data supports this strategy. A study by Vanguard found that investors who practiced dollar-cost averaging between 1995 and 2004 achieved higher returns than those who attempted to time the market perfectly. In fact, the average investor in the dollar-cost averaging group ended up with over $10,000 more in their savings after just 5 years. But dollar-cost averaging is not just about investing for the long term. It's also a mindset that helps you stay disciplined and avoid making emotional decisions based on short-term market fluctuations. When the markets are volatile, many investors get spooked and pull out of their investments at the worst possible time. By sticking to your dollar-cost averaging plan, you're less likely to fall prey to these impulsive decisions. Section 2: The Dangers of Market Timing. Market timing is another common mistake that can cost you thousands in fees and lost opportunities over time. This involves trying to guess when the market will rise or fall and adjusting your investment strategy accordingly. While it may seem like a surefire way to beat the market, the reality is that even professional investors struggle with timing. Consider the case of Warren Buffett's Berkshire Hathaway, which has outperformed the S&P 500 over the long term despite being managed by one of the most successful investors in history. But look closer and you'll find that Berkshire's returns have been highly dependent on its ability to adapt to changing market conditions. When the market was tanking in 2008, Buffett's team made a series of bold bets on undervalued companies, which ultimately paid off handsomely. However, for individual investors, trying to time the market can be disastrous. A study by Charles Schwab found that over 90% of active fund managers underperformed their benchmark indexes between 2009 and 2018. This is likely due in part to the costs associated with buying and selling securities, as well as the emotional biases that drive investors to make impulsive decisions. The lesson here is clear: avoid trying to time the market at all costs. Instead, focus on building a diversified portfolio that's designed to withstand market fluctuations over the long term. Section 3: The importance of diversification. Diversification is often touted as one of the most effective ways to reduce risk and increase returns in your investments. But what does this really mean? In essence, diversification involves spreading your investments across different asset classes, sectors, and geographic regions to minimize exposure to any single market or sector. Consider the example of a 401k plan that's heavily invested in technology stocks during the dot-com bubble. When the market tanks in 2000, investors who were heavily weighted towards tech stocks see their portfolios plummet by over 70%. However, if those same investors had diversified their portfolio across multiple sectors and asset classes, they would have been much better insulated against these losses. The benefits of diversification are well documented. A study by the Journal of Financial Economics found that diversifying a portfolio can reduce volatility by as much as 40% while increasing returns by up to 20%. This is because diversified portfolios tend to be less correlated, meaning they move in different directions when the market fluctuates. But how do you achieve true diversification? The answer lies in building a long-term investment plan that incorporates multiple asset classes and sectors. For instance, consider investing in index funds or ETFs that track specific markets or sectors, such as real estate or international stocks. By spreading your investments across these different areas, you can create a portfolio that's more resilient to market fluctuations over time. Section 4: The risks of emotional decision-making. Emotional decision-making is another common pitfall that can cost you thousands in fees and lost opportunities over time. When the markets are volatile, many investors get spooked and make impulsive decisions based on fear or greed. They may sell their investments during a bear market, only to miss out on the subsequent rebound. Consider the case of 2008, when Lehman Brothers filed for bankruptcy and sent shockwaves through global financial markets. Many investors panicked and pulled out of their investments at the worst possible time, missing out on the subsequent rally as the markets recovered. The lesson here is clear: avoid making emotional decisions based on short-term market fluctuations. Instead, focus on building a long-term investment plan that's designed to withstand market volatility over time. By sticking to your plan and avoiding impulsive decisions, you can increase the potential for long-term growth and reduce the risk of losses. Section 5: The benefits of tax loss harvesting. Tax loss harvesting is another strategy that can help you save thousands in taxes over time. This involves selling securities that have lost value and using those losses to offset gains from other investments. By doing so, you can reduce your tax liability and increase the potential for long-term growth. Consider the example of an investor who sells a losing stock at the end of the year, only to reinvest the proceeds in a different security. If that same investment generates a gain over the subsequent year, the original loss can be used to offset those gains, reducing the tax liability and increasing the overall return on investment. The benefits of tax loss harvesting are well documented. A study by Fidelity Investments found that investors who practiced tax loss harvesting between 2015 and 2020 achieved higher returns than those who did not. In fact, the average investor in the tax loss harvesting group ended up with over $10,000 more in their savings after just 5 years. Conclusion: the financial mistake that costs you $100,000 over time is a common pitfall that many investors fall prey to. By sticking to dollar cost averaging, avoiding market timing, and practicing diversification, we can avoid this trap and increase the potential for long-term growth. Additionally, by incorporating tax loss harvesting into our investment strategy, we can reduce taxes and increase overall returns. So what's the takeaway here? The key is to build a long-term investment plan that incorporates multiple strategies designed to withstand market